Good morning, everyone. It is Throat Punch Thursday, September 22nd. I think they need to move the Fed meetings to Thursday because, well, it's Throat Punch Thursday, and that's what it felt like yesterday, did it not? Okay, so here we go. We're going to take a look here, and this line here is the long-term trend line that brings us back to the June lows. Let me put it on the SPY, and I want this to really be a good perspective. And then I'm going to talk a little bit about the potential bull case going forward, even in a recession. Yes, that is what I said. Even though the bond market, which is really where we should take our cues as to where we're going, the bond market yield inversions, even in the super long term, are showing us a recessionary future, right? We already know that certain areas of our economy are in recession. And I'll get a lot of pushback for this, saying that we still need to pay attention to the jobs market. I do know it's a lagging indicator, but even as a lagging indicator, the strength within it, if we get the typical drawdown in employment, still not going to be recessionary. So do I think that our overall market is strong? I think that there are some really key strengths in the market that kind of get thrown out like the baby in the bathwater, which doesn't make sense to me because I guess I just don't look at things like that. It's not an all or nothing kind of proposition, but a lot of people in the market do kind of overlay that onto the market. But here is my bull case. And yes, I am a kind of a perma bull. I know that. Do I think we have more downside in us? I would not be surprised if we did come back to 375. Okay, that's my personal opinion. Doesn't matter. We also have two gaps down here. So even seeing this gap down here at 370, potentially not a terrible spot. A double bottom to the June lows in 362 would be incredibly strong for the follow-on move forward. But here's the thing. In recession, we typically move somewhere around 35% down. Does anybody know how much we've lost since the high? We've done that. We have moved past that area. So what I'm saying is we've had these areas in the market that have been recessionary a little bit longer. So they're going to be a little bit ahead of the curve. When we look back at previous recessions, or we look at crashes, people call them crashes. I think that we don't really have a lot of crashes in the market. We have a lot of, recessions, right? I mean, that's what they are. Crashes is something that happened on, in 1929, right? That was a true crash. It actually pulled everything out and there was no recovery. Not saying we haven't had them. We've had a few of them. But I think we overlay and say, oh, it's crashing, and it's really not. So, okay, so let me get off of that for a minute and get back around to markets tend to kind of follow patterns. When we have seen these really big, whether it was the tech bubble, the housing fail, the too big to fail, right? We all remember that. Even inside of those, that was so broad. It affected every sector across the board, and it was fast. It was very fast. So we had this complete drawdown in the market, not just the market, but across the board in what we consider our economic world, meaning our jobs went away. Inflation was kind of a mess. And then we ended up, of course, with a bunch of supply because no one could pay for anything. I mean, it was a mess. So when you look across the board at our daily living, everything was suffering. Well, we don't really have that right now. And the reason I feel like that's important is because that allows us to kind of maybe, instead of, if you think of it like a great big ship, instead of turning all the way over, and maybe even capsizing, that keel is a little bit longer. And although we can be extremely volatile, we're still going to stay upright enough to not capsize. And I think that is a very important area for us to when we overlay our opinion on the market, right? You absolutely have opinions about the market. Just don't let that bias everything in your trading. That is a very dangerous place to be, because then you hold on to things. You aren't willing to step back. Now, I do believe that we may have, like I said, more of that pullback, maybe about 5% more. But we've hit such a trend. But here's my bull case. This is a great potential for buying long term. I'm not talking about someone who needs their money back in a year or two. I'm talking, we're looking at 5 years to 10 years. When we go into a recession, the year coming out of it, our returns tend to be about 20%. Then they increase. So when you're looking out at the 2-year, the 5-year, the 10-year, it is still a better place to be in the market than keeping your money under the mattress. Now, invest in some good, solid things that aren't just, a run-of-the-mill day trade, right? Day trades are great, but keep a lot of your powder dry for the opportunity to take advantage of what's coming in the longer term, right? So that it may take a month to play out. It may take 3 months to play out. But I'm telling you, pay attention and listen to the market. We heard the Fed a bit more hawkish yesterday, and he kind of danced around stuff. Now, don't forget, his job is to kind of be that very calm, cool head, be very measured. Every word is chosen very specifically. And we really dipped back down because we had the initial drop, and then we came up, and then we dropped again. And it really was on the market digesting. We are going to keep going as hard and as fast as we can until we fix it. The problem is, by the time they know they fixed it, it will be too late. The Fed does not act proactively. They are reactive, which is not a great thing to do. Be proactive. So I think we're going to have a little bit more pain in the near future because the Fed won't allow the market itself to take care of the supply-demand issue. And that is a very important part of our market, is allowing the market to figure it out, because the markets are smarter than us. The markets are already looking longer term. The bond market was signaling months ago that this was coming, and yet still it took a year for the Fed to even do anything, which was crazy. They should, and now we are in a declining market, right? And that's okay. Markets can't always just go up. We're in a declining market and they're raising rates. When they could have done that earlier, probably just smoothed it out. So I don't want to hear anything on the news about a safe landing. We are so far past a safe landing or a soft landing, that now I'm just looking for a mostly safe landing, right? And I think that you just have to kind of tune out what a lot of people are saying. We have a lot of other stuff going on in our economy as well, our global economy. Other countries, we're the stronger of these other countries, and we're not propping up the same way that like China is, right? They're a hot mess. But Japan actually had to prop up their yen a little bit here, and they are very conservative in doing so. But across the world, we have now seen rates rise in several other countries following us, and then leading into us, other countries had they raised theirs just before we did. So this is a global issue. But of the markets out there, honestly, we are still one of the best places to put money if you have money to invest. Okay, so what am I doing today? I found some good charts. I found some bullish. I found some negative, bearish charts. But I'm going to watch and see where we actually end up here today. I want to see the continued digestion of what actually happened yesterday, watching those yield curves in a more close fashion, because the super long term, the 30-year, and the 1030, it has really given us a big signal. So if you're looking for maybe some investments, not just day trading, but some investments, some good quality bonds might not be a bad place to go with the higher treasury yields. Okay, but this is our look here in the pre-market. This is the S&P future. So this, this started at midnight. And here we go. You can see where we're moving at now. I did notice that, interestingly, although above, you know, we have some more volume over the last several days, that even yesterday's volume wasn't quite what I thought it would be. I thought it would have been pushed down much harder, but it may have just been because over the last couple days the selling was kind of petered out. And now we can get some new buying in. We're seeing a little bit of a recovery here this morning, but not a surprise because we are incredibly oversold. So we may see a little bounce around the 10:30 a.m. Eastern. Kind of look at that point, 10:30 to 11, and see, okay, have we finished our selling? This is why it's so important to watch the tick chart. The tick chart tells us it's just a raw data, buying, selling. That's all it is. So really pay attention to that, and I'm going to say pay attention to the advanced decline. Our VIX wasn't really up all that much compared to earlier, and that may have just been because we've seen this decline for a while. So a lot of that, maybe that volatility has kind of, you know, petered out. We've been more volatile as of late than like in the last week or so versus over the last month. But overall, I was kind of surprised. I thought we would have seen a bigger spike in the VIX yesterday. So pay attention. Listen to what the market is telling you. We just got initial claims out. The initial claims were less than expected. That is a good thing. And the continuing claims as well were less. Now remember, that is a lagging indicator. I understand that. But I think this is still a strength in the market. The biggest problem is how much the pay is, right? Because with inflation being over 8%, even though the pay has gone up 3 and 4%, obviously there's that gap. And we fill the gap by paying more for stuff and not being able to do as much stuff, right? So we're laying out as much, if not more money for less stuff. So we will continue to watch that. We don't have CPI data now until October, but October also kicks off a new set of earnings. What is going to be in those? I think this is going to be a real telltale. Typically, the fourth quarter is a good quarter for earnings. Are we going to have that this time? I think we're much more on the fence, but we'll take it one day at a time, right? So swing trades kind of harder unless you're looking at super long term, something you're willing to leg into and allow it to fluctuate by maybe 5 or 10%, and then. And cost basis, average cost basis is really the place to be for a long-term investment. If you're shorter term, you're just looking for those day trades. We've definitely had enough volatility for day trades lately. Just be cautious. Okay, a few that I am watching. I know this video just got way long, but I still like solars. We saw solars yesterday take a really nice run. Get it? Run? See, it's right there. Okay. And yes, it pulled back with the entire market here, but I really like run. FSLR ended up closing green. SunPower ended up closing green, although downside. See, Nova is another one. JKS, ENPH. Okay, so I do like solars here this morning. So keep an eye on those. Even if they did end up kind of red, I would keep an eye on them. A couple others that are still valid. Again, pulled back the rest of the market, so I know yesterday's candles and all of these look terrible. But this is still a pretty decent. It fell out of a bull flag with this big pull yesterday, but keep an eye on it for it to turn around. Netflix, same thing here, right? So kind of a leaning bull flag. I really do like Netflix still. Oh, no, wrong one. Dang it. Oh, SAVA. That was the other one. I was kind of watching this one yesterday. I really wanted to hop in here. And it shot up early, came back down, ended up just inside. What I like about this news catalyst was on that there was no wrongdoing, and there's not going to be a forward-looking anything to do with the SEC. They're totally good. They're cleared. So look for this to potentially turn out as a bull flag as well. So what's on the downside? Well, pretty much, let's look at the SMH. So watch those chips. We did see a bounce early, but they turned right back around and gave it back. Some meme names, GameStop, KSS continue to fail. But if we do have a rougher day, take and pay attention to healthcare. Oh, wait, no, it's just certain names in the healthcare stock, I should say. So even though some of these came back in, healthcare started out the day pretty good, gave most of it back. Well, I guess maybe not. Some of the healthcare names this morning were doing all right. So we will come back and take a look at those. I know, that didn't sound very convincing, did it? And pay attention to Bitcoin here. Bitcoin, 18,000 really seems to be a very good place of support. It's green this morning, clear downtrend, but I will repost a chart regarding Bitcoin and the wave it's sort of in. And 18,000, right around 18,000 is the support level, and we've hit it. If you go back, we've hit this so many times and keep holding that 18,000, so we'll pay attention to that. And also pay attention to some energy plays. Those actually started out yesterday doing pretty well. Came back in like pretty much everything. You know, the tide went out and took everything with it. But pay attention to energy plays with this more aggressive rhetoric from Putin. I don't need to get into the geopolitical battle there. We're coming into winter. So not just oil, but like nat gas, things like that. Pay attention to the energy market. I think that we could see a more of an uptrend starting in energy. Okay, that is it for me here this morning. I hope you have a fantastic day. I'll be watching the market along with you. If you have any questions, reach out, heatherc@givingtreetrading.com.